Hi all, I hope you've got your lunch and you're sitting comfortably in your chair. We're going to kick off this RegCentric webinar right now. Thank you and welcome again to this RegCentric webinar series. We are focusing again today on the APRA regulatory timetable changes that are occurring particularly due to the COVID-19 impact to, well, everyone and every industry. A lot has changed over the last couple of weeks. When we provided an update on COVID-19 3 weeks ago, the world was quite different than it does today. In our session, we provided an update on the areas of focus for APRA and their focus for 2020 and beyond. Many changes have happened in the last few weeks, and today we will give an update to the announcements made by APRA that are important for finance and risk departments. Some housekeeping. To ensure the best experience for yourself and all other guests on the line, please ensure that your microphone is on mute when you join the webinar, and just check that along the way as well. You can raise questions to the speaker using the text box, if that's okay. To the right of the screen it should be located, but it could be elsewhere if you've moved it during the introduction area and time that you've been here. We will do a Q&A towards the end of the session, so please put those questions in that text box when you get a moment, and we'll endeavour to answer those in the time frame we have allocated. The time today for the webinar, we will finish at 1:15, which is all Eastern Standard Time now. It's my pleasure today to reintroduce Thomas Fillet, who delivered our previous webinar. Thomas builds on this discussion today as founder of RegCentric, and he is deeply focused on a number of organisations impacted by these and other regulatory changes. Thomas has a decade of extensive experience in providing consulting and implementation services across finance, risk, management, compliance and audit functions at major and emerging financial institutions across Europe, Asia and Australia. We're also joined by Ignatius McBride, who is a senior data analyst. Prior to joining RegCentric, Iggy was a member of the banking analytics team at APRA, and he brings an amazing understanding of how ADI reporting is completed. We welcome our speakers and you as guests today. I'll now hand over to Thomas Fillet.
Thank you, David. Welcome everybody from my end. So, COVID-19 crisis has moved incredibly fast, and we thought it would be worth spending a few minutes on kind of recapping the timeline of this current crisis. So the slide you have hopefully in front of you, I guess shows that from the very first cases that have been detected in China back in December until today, I guess on the bottom of the slide we have the kind of public announcements and the changes that have happened, whereas on the top we have listed what APRA's focus or announcements were during those periods. And yeah, as you can very much see on the slide in December, it's pretty much still business as usual while the first cases are being detected in China. It's in 25th of January that the first case of COVID-19 is recorded in Australia. And if you think about it, that's really only been about 10 weeks ago. But even then, in January and in February, domestically, still business as usual for the regulators. It's in February of this year that APRA is starting to kind of taking first steps internally to assess the potential impact of the event surrounding COVID-19, predominantly in terms of assessing its own readiness from an operational perspective, ensuring that their operations are safeguarded as well as their staff. It's on March 11 that the WHO declared the coronavirus a global pandemic. And on the 12th of March, the Australian government announced its first stimulus package. And for recollection, there was about 17.6 billion in stimulus that were announced on that day. Things moved very fast after that. On March 16th, travelers entering Australia needed to self-isolate for 2 weeks, and only a few days later, really on March 20, the borders physically closed. On March 22nd, the government announced the second stimulus, lifting the total to almost 190 billion. And only 8 days later, the government announced yet another program, the JobKeeper scheme, adding an additional 130 billion worth of economic stimulus. And actually several more targeted measures have been announced later. So the pace of these policies announcements have been truly extraordinary, as well as is the scale of the government intervention. So today we are 8th of April, and it looks like in Australia we have been reasonably successful in flattening the curve at this stage, which you can see here on the infographic that the government publishes on a daily basis now. There are still very many unknowns, both in terms of the length and the extent of the lockdowns, in terms of the next steps of what will happen in terms of loosening those restrictions. We don't know when businesses will be allowed to reopen. We definitely don't know when we will be allowed to travel again domestically, let alone internationally. So we do know the economic shock is going to be big. We know that there are sectors that have seen pretty much their entire revenues dry up overnight. And we also know that the situation is unlikely to improve for many months and maybe even longer. So we know that this will mean that credit and liquidity risk events materialize. And we have seen initial, evidence through rating agencies adjusting credit ratings. We also know that the markets tend to react wildly in uncertain times and that volatility is at historic highs. We also know that there are many households that will experience hardship. And yet we also know that the government is acting quite decisively in absorbing the economic shock, and that also the banking industry is or has vowed to do their part in ensuring Australia is in the best possible position on the other end of this crisis so it can recover from this shock. In the hope of having businesses currently still having their employees on their side at the end of this. We also know that the banks are not at the heart of the problem this time, which was the case during the GFC, and that they have started this crisis with strong balance sheets. We have also seen regulators shift priorities to support the industry and shifting their own priorities to focus on their customers. And as mentioned in today's session, we will cover the changes made by the regulators that are most relevant to finance and risk professionals. So I will start with some of the key packages announced by the government, and then Iggy will zoom into all of APRA's detailed announcements. So from the government side, over 200 billion in direct support has been allocated to businesses and households. So that includes the job keeper payments as well as measures to boost cash flows for employers. If you would like to get a detailed breakdown of all these measures for households and businesses, we definitely encourage to have a look at our friends of BDO and Deloitte, who provide really good insights, especially from an accounting and tax perspective. One of the other measures that have been announced by government is the SME guarantee scheme. So under this scheme, the government will in fact guarantee 50% of unsecured loans that are granted to SME lenders. So there are a certain number of terms and conditions around that. So the loan size is maximum to $50,000 per borrower, with a duration of up to 3 years and a 6-month initial repayment holiday. So I guess important to flag here that this is about unsecured finance, so borrowers would not have to provide assets as part of the collateral to those loans. And Iggy in his section on APRA will also highlight how APRA will support the government in the execution of this scheme. Also for small ADIs and non-ADIs, the government has announced a particular package. So through the Australian Office of Financial Management, up to $15 billion will be invested in structured finance used by smaller lenders, and that includes both non-ADI as well as smaller ADIs. So the support will be provided by making direct investments in the primary market securitizations by these lenders and in warehouse facilities. So the AOFM will be purchasing assets that both support small businesses, both secured and unsecured lending, as well as consumer lending, which would include personal lending. This program will assist the smaller lenders who will not be able to benefit from the RBA's term funding facility, which I will touch on a little bit later. So even the smaller end of town will be able to access funding And the government also wants to, it has since stated this package to support competition in the market. Now, an example of this funding in action is that very recently the AOFM has invested its first tranche of 250 million in securities issued by a warehouse sponsored through Judo Bank, which, as you may know, is a neobank that has a business focused on SME lending. The AOFM is actually also going to be tasked with finding the $200 to $250 billion worth of funding in the next couple of months. So they'll be pretty busy. The RBA, from their side, they have, we've had two rate cuts in March, 2 times 0.25%, and the cash rate is sitting currently at 0.25%. And the RBA has also started a quantitative easing program and has been essentially buying debt securities in the primary market over the last weeks. And I think they're currently sitting at about 36 billion of direct purchases they've made. All of that is to keep the interest rates in the markets low, so that both banks as well as government can fund their investments through low credit. Additionally, the RBA has announced a term funding facility, which is a $90 billion package in funding at a fixed rate of 0.25%. So this will be allowing banks to reduce their funding costs and will in turn also help reduce interest rates for borrowers. To encourage, again, lending to businesses, the facility offers additional low-cost funding to banks if they expand their business lending with particular incentives, again, in that SME market segment. And also, ASIC has announced a number of initiatives. I guess first and foremost, they're suspending non-time critical regulatory initiatives. They've also issued guidance, particularly around those parts of the industry where they hold licensing mandates. So superannuation and insurance have had particular announcements made around that. But probably important to note is also that as part of their announcements, ASIC has flagged that their remediation and enforcement actions that are in flight or on the way are not affected. So they do very much expect all market participants to continue with those programs. Now, what does that all mean for the economy at large? It is, of course, very hard at this stage to actually measure the impact. But there are quite a few, organizations that have released outcomes of their economic modeling, which we thought is worth sharing. So the first one is on the Organization for Economic Cooperation and Development, so the OECD. They have essentially given a bit of a broad brush approach. They expect 20 to 25% decline in economic output, broadly resulting in about a 2% decline in GDP forecasts for each month of containment. And that is without compensating government action. So essentially, if we're in lockdown for 2 months, that would be an overall decline of 4%. If this is a 6-month lockdown, that would result into 12% decline in GDP. Closer to home, this week the AFR has released its quarterly economic survey, which was very timely, so that is post and government announcements around all the various stimulus packages. And so there's a consensus view from the economists of the bigger banks that GDP within this financial year, or calendar year rather, will be impacted, say, between 3 and 5%. So you can see here on the screen, Westpac estimated 5% and NAB 3%, and ANZ and CBA are sitting in the middle there. Median forecast, therefore, is about 3.9% of contraction within this calendar year. And also, from an unemployment perspective, the median forecast is an increase from the current level, which is around 5% to 8.5%. Again, that's taken into account the various packages the government has announced. And also, from a CPI perspective, it'll be lower. The median estimate there is that it will be ending up lower than the target range of 2 to 3%. Another agency that has released earlier this week a white paper on GDP impacts is the BIS, so the Bank of International Settlements. And I've highlighted here that Australia sits within the other advanced economies bracket, so that's in Canada, Australia, Great Britain, and a couple of others, where I guess what's interesting from BIS perspective is that they have modeled several possible outcomes, so less severe as well as more severe conditions. And they've also made an assumption around how the recovery would work. So they're talking about the V-shaped or the W-shaped recovery scenarios. So under a V-shaped recovery, the economy bounces back after an initial lockdown period, whereas under the W scenario, the loosening of restrictions is followed by a retightening of restrictions when the number of cases rises again after the initial loosening of restrictions. So I guess very recently we've seen that in a country like Singapore, they're actually retightening the restrictions after actually going through the loosening of restrictions. So I guess it's a more likely scenario now that W-shaped recovery scenario will play out. Now, in all of these scenarios, the contraction of the economy sits within 3 to 5% in 2020, with a gradual recovery in 2021. There are also initial signs of second-order effects in the housing market, with clearance rates dropping significantly for March. But it is early days to really kind of get an assessment of the impact on the housing market at this stage. Now, why is all of this important? As we had already flagged in a previous webinar as well, there is a certain unease about being able to look at the impact of expected credit losses. So under the AASB 9 rules, entities are required to consider both historic, current, and forward-looking information, including macroeconomic data, when they estimate their credit losses. And in essence, it means an earlier recognition of credit losses. The International Accounting Standards Board, so the IASB, has issued certain guidance for entities preparing their financial statements, and specifically around IFRS 9. The guidance touches on a couple of things. So first of all, in assessing the forecast conditions, consideration should be given to both the effects of the COVID-19 and the significant government support measures being undertaken. IFRS 9 requires the application of judgment, and it requires that entities adjust their approach in determining ECL given the different circumstances. So a number of the assumptions that may have been implemented originally may no longer hold in the current environment, and therefore entities need to continue to apply, judgment and not apply their ECL methodology mechanically. So, for example, extension of payment holidays to borrowers doesn't necessarily have to be considered to be a significant increase in credit risk. And so, I guess from a recognition perspective of credit losses, you don't necessarily have to do the stage transition from stage 1 to stage 2. So in order to assess significant increase in credit risk, entities should look at the changes of the risk of default over the expected lifetime, based on reasonable and supportable information that is available to an entity, and I guess without undue cost or effort. So it is likely to be quite difficult at this time to incorporate specific effects of COVID-19 and government support measures on a reasonable and supportable basis. However, the changes in the economic conditions should be reflected in those macroeconomic scenarios applied by the entities and their weightings. So the IASB has issued guidance that if the effects cannot properly be modeled, then it is very likely that post-model overlays and adjustments will be needed in order to, maintain or ensure that the ECL provisions are fit for purpose under the current circumstances. And also, APRA has provided some additional guidance on this. So, where the borrower has been meeting their repayment obligations, any, actions taken by banks in order to reduce or give holiday or repayments, they would not need to treat those repayment holidays as periods of arrears. And also similarly, loans that have been granted a repayment deferral as part of the support packages don't need to be regarded as restructured. APRA will be writing to all the ADIs to advise them of the specific reporting treatment of these loans that are being subjected to the deferral. And they'll be also, or the industry will be required to publicly disclose the nature and as well as the terms of these repayment deferrals. And more details of that will be released by APRA in due course. Now, what's the impact overall or the estimated impact on credit losses? So there was a report that came out from S&P, specifically on the Australian case. So their estimate is that credit losses would rise from the historic low level of 0.14% in 2019 to about 0.5% in 2020, mainly driven by business loans, and especially in particular sectors. So probably comes as a surprise, tourism, transportation, retail services will be among the most affected in the current environment. S&P did also issue guidance without really quantifying that also for households, they do expect a rise in expected credit losses due to the losses in income for many households. So that leaves me with some practical considerations for accounting for ECLs, and I know that a lot of entities have they've issued questions to us, and they've been talking to their auditors as well. What is the actions they can take in the current scenario? So a couple of practical considerations here. That first of all, to revise your macroeconomic forecast and to use both internal and/or external sources of information. And some of these sources have been shared in the last couple of minutes. We also recommend that entities look at aligning their scenarios used in ECL with their wider stress testing and ICAP scenarios, and to not stick to one scenario, but to use multiple possible outcomes. So to go, for example, with a mild, severe, extremely severe type of scenario, and then assign probabilities to each of those. It's going to be very important to engage with the relevant stakeholders, the credit risk, ALCO committee, to really validate the scenarios and the assumptions, and continuously look at the latest information as it becomes available and adjust the models and assumptions accordingly. And probably from an individual impairment perspective, look into those key sectors that are likely to be most hit, such as tourism, transportation, and retail. We also do encourage everybody to reach out to their auditors, especially those entities that are on year ends in March and later down in June, to engage auditors and get their early opinion about the models and the inputs from a macroeconomic perspective. And then lastly, that any management overlays that are likely to be required, that they are subjected to appropriate governance. So, it's important that through the relevant stakeholders' engagement, the right levels of governance are put on top of any overlays that happen as part of the IFRS 9 expected credit loss reporting. With that, I'll pass over to Iggy, who will walk you through the key changes announced by APRA.
Thank you, Thomas. And thanks to everyone who's joined us on the webinar today. So as Thomas said, I'm going to build on the scene already set, detailing APRA's regulatory response and going into what that means for the regulatory pipeline and current supervision activities. I'm also going to provide a few insights and help unpack what that means for those of us who work in the finance and risk and data reporting spaces. So right now, APRA's primary focus is on monitoring the impact of COVID-19 on the financial and operational capacities of its regulated entities. So in light of recent global financial market volatility, APRA has been working with the Council of Financial Regulators, the Australian Government and its peers, like the Bank of International Settlements, in coordinating a multilateral approach to the COVID-19 pandemic. This includes taking their own BCP steps to protect their staff and critical operations. I think that's something that we can all relate to on the line today. APRA also engaging with entities using its cross-industry pandemic planning guidance, that's CPD 233, to understand how COVID-19 might affect their operations. They'll be using that as a benchmark, and ordinarily they would be assessing entities' response to understand their readiness to cope with the disruption. APRA's response has been swift, as Thomas has said. There's been a number of announcements in the last few weeks, and most notably they're providing relief from their unquestionably strong capital requirements set in 2017. So the regulator has urged banks to seriously consider also suspending their dividend payments until there's more certainty about the impact of COVID-19. They didn't go as far as the UK regulator in getting banks to agree to scrapping all dividends and share buybacks in 2020. But the idea here is to free up Australian banks' capital buffers to encourage lending in the domestic economy. They're also encouraging banks to take advantage of the RBA's new term funding facility. APRA said it'll allow entities to include this TFF in their liquidity coverage ratio, their minimum liquidity holdings ratio, and net stable funding ratio calculations. So I would highlight there are a few reg reporting considerations there. APRA will also be supporting the government's SME scheme through additional reporting. So I would imagine that would look similar to the ARF 910. That's the financial claims scheme data collection. And given that this information is going to be shared across multiple entities, it's likely that there might be a few forms in that collection. However, the details around this are yet to be disclosed. So APRA have given some advice, as Thomas touched on, around the treatment of COVID-19 support packages for the banks. So for example, banks should not treat repayment holidays as a period of arrears where a borrower was currently meeting their repayment obligations. Similarly, loans which have been granted repayment deferral should not be regarded as restructured loans. So these treatments will flow through a number of reporting forms, I would imagine, and affect things like provisioning, which then hit the 720 balance sheet, and also impaired facilities reporting in the 220 series, to name a couple. I'd also add here that this advice aligns with the announcement from the Australian Banking Association recently that borrowers who are granted a 6-month grace on loan repayments will not have their credit ratings affected, and that's only as long as they were up to date with their repayments at the point that they applied for that grace. So interestingly, and in that last point on the slide, APRA has flagged to ADIs and RFCs that the terms and volume of any repayment deferrals are to be reported to APRA and also publicly disclosed. So this means that credit teams are going to have to be working closely with customer-facing teams to identify and start collecting that data now. So this, as you can imagine with all those announcements, there is going to be some amendments. And looking at APRA's regulatory pipeline, they have revised their 2020 priorities, which they announced early in February. And similar to ASIC, they've suspended the majority of all their non-critical policy and supervision initiatives. So just today, APRA made an announcement that it's temporarily suspended the issuing of all new banking licenses. So this is most likely to affect the Neo, Challenger, and even overseas banks who are currently going through their applications. APRA has also delayed its public consultations and the implementation of a number of new policies and standards that I had planned for this year. So I think the most notable there is in terms of capital in the Basel III reform. They've pushed that back by 1 year to 2023. They've also delayed the implementation of the Phase 3 form, that's the ARS 730, the fees and charges, until March 2021. And they've delayed their consultation on determining ADI data, which is non-confidential, which would have seen increased reporting and transparency in banks' financial performance data to the public. Another big thing to note is that APRA has suspended their APRA Connect program until further notice. So this is the project which was to create a tool to replace D2A, which is APRA's current data collection platform. So at this point, I would flag here to expect more changes to APRA's regulatory pipeline in the coming months, and I'd highlight that the intention from APRA is to allow banks to dedicate more time and resources to maintaining their operations and supporting their customers in keeping the economy afloat. So I just want to bring this home to what that means for those, especially in the reporting space on the line. So in periods of high uncertainty and market volatility, there's actually an increased need for more timely and accurate data to understand the rapidly changing environment. I think we'd all agree that there's a lot of uncertainty in the months to come. And consequently, APRA has announced a number of additional reporting obligations for banks and RFCs. So firstly, they've extended some of the EFS parallel reporting requirements to extra quarters until June 2020. Now, the idea behind this is to provide the agencies, that is APRA, the RBA and the ABS, a consistent time series of data that they are familiar with and have confidence in, because they wouldn't have been able to make the transition yet to the new forms. And what they really want to know now is movement in historical trends. Now, the other thing that's listed there, which is important, is the quarterly business indicator survey, which goes to the ABS. Now, this is one of the main components in calculating quarterly gross domestic profit figures. So it's quite important that this continues. APRA also asking certain entities to report the daily liquidity report. That's the ARS 210.5. And currently, I believe that's twice weekly. And in addition, as we touched on earlier, APRA will be supporting the Australian Government SME Guarantee Scheme collection through a new reporting standard, which will most likely result in a few forms. And I say that because this needs to provide a macro view for the RBA and the government to understand how this is supporting the economy, but also APRA need to understand the characteristics of the loan deferrals, so there might be more detail required there. APRA, in asking for new reporting obligations, have also loosened a little and provided some concessions. So the first I'll probably highlight is that they've brought forward their consultation and brought it into effect on standardising quarterly reporting dates. So what that means is any form which was due prior to 35 calendar days will now be due on 35 calendar days. And anyone that was due after 35 calendar days will be due on that date. And that's for quarterly forms, and I'll probably highlight to those in the reporting space to double check that, because there are some caveats there. They've also extended the SLA on data validation queries from 2 to 3 working days. So I wish you all good luck there with that one extra day. And lastly, APRA have extended the compliance timeline for all notifications under DARE from 14 to 30 days, and that took effect on the 6th of April. So this takes us to what to expect next. And a key thing I'd like to highlight here is that the decisions by APRA regarding policy and supervision initiatives are intended to allow ADIs and RFCs to dedicate more time and resources to maintaining their operations and supporting their customers. However, these decisions are not to come at the expense of providing timely and accurate information to APRA, and entities need to maintain their reporting obligations in this period of uncertainty. APRA will be expecting ADIs and RFCs alike to display a readiness for all new reporting initiatives. So this might look like further ad hoc collections outside of the SME guarantee scheme, or simply just more frequent submissions of existing data collections. APRA will also continue to intensify its focus on monitoring and responding to the impact of COVID-19, looking at different policies, and they also are going to have to work hand in glove with the federal government and the Council of Regulators to actually bring this to effect to support the economy. So I guess that brings us to my last point, that for those of you working with or across internal regulatory teams, please expect more formal communications in the form of letters and guidance notes, and more informal communications, such as direct contact from the APRA supervisor in responding to this pandemic.
Thank you, Iggy. Yeah, we thought we'd finish up the session by summarizing the key takeaways from the session. So, I guess first of all, ensure that from a processing perspective, you are ready to identify and capture any deferrals or I guess relaxation of repayment terms that are granted to customers, whether they're business or households, as part of the COVID-19 response. Because as we all know, reporting at the back end will only be as accurate as the data that was captured at the front. So, considering that APRA already announced that they will need entities to disclose these loans, the terms of those specifically to them as well as to the wider public, it's important to make sure that you have the right processes in place that identifies those data, I guess through the wider population of all the loans. Be alert for more ad hoc data requests and regulatory engagements in the weeks and months to come. With regards to expected credit losses, I guess using the best available information as it is available at the time of when the financial statements are due is important, and it's key not to just apply the current ECL model kind of mechanically, but I guess to take into account the current environment more pragmatically. Apply a more proactive or apply a proactive approach to managing the capital using stress testing methodologies. It's only in February of this year that APRA released their results of the stress testing they did, I believe in 2019 with the ADI industry. So there's definitely some lessons learned and some best practices that have been shared by APRA. It would be prudent for every entity to take into account those suggestions. And yes, expect more formal and informal communications with APRA in the weeks and months to come. So with that, and I'm very pleased we stayed within the allocated time, we'll open the floor to questions for the last 5 minutes of the webinar.
Thanks, Thomas. So anyone who's got any questions, just while Thomas is checking the text box submissions, if you'd like to write any more questions, please go to that text box and ask any questions. I know it's reporting season at the moment, so if you've got any questions around how some of these regs might impact those reporters, jump on there, or any questions around timelines. I'd also like to draw your attention to the contact details on the page in front of you as well. So there's quite a number of white papers and information slips, and also the previous recording on this subject matter, which is in prelude to this. It's on the website, so it's at www.regcentric.com. Feel free to get access to that. And if you do have any questions after this session, please do contact Thomas, Iggy, anyone on the team here at RegCentric to go through any of those questions you may have and how it would apply to your organisation and your particular problem. Thomas, have you got any questions there?
Yeah, I did have one question come through. So the question is, for banks that have a March year end, do we expect they would be adding footnotes in their stat accounts to explain shifts in ECL? And I could probably take that one. Because the answer is yes. The March year end information would have been available, that the economy is dramatically impacted by the current circumstances, and yes, we would expect that entities that have a year-end reporting due on end of March, that they would have taken into consideration changes in those macroeconomic forecasts based on the best available information they have, that they would have assessed their portfolios and would have looked into the exposures in the kind of high-risk sectors, and that they would have assessed borrowers individually in those sectors where there are material exposures. So yes, very much so. I believe there's some of the larger entities. I think Macquarie is on a March year-end, so when their reports are released, I'm pretty confident they would have quite a large chunk of information around the assumptions and the impact they have experienced in estimating the expected credit losses. I hope that answers the question. If not, then feel free to ask a follow-up question. There was another couple of questions. So one of them is, do you see year-end deadlines being pushed back by ASIC? Yeah, I don't know, Iggy, if you want to take that, but maybe just my 2 cents is I don't believe that ASIC will be pushing back the actual deadlines. They did announce that from a general shareholders meeting that they would not be, or they have taken an approach that they would not expect, of course, in the current environment for those sessions to take place. But I have not seen any guidance to say that the deadlines are being pushed back at this stage.
Yeah, same here. That all I've heard about is in relation to ATMs. Nothing on pushing back deadlines today.
Another question we have is if we've received any more details on the new form. So that would be regarding the SME guarantee scheme, presumably. Maybe Iggy is something you can take?
Yeah, sure, Thomas. It sounds like in its development stage. I think a few things we could probably speculate confidently is that it'll most likely be on a domestic books consolidation, looking at more of a portfolio to date kind of view. And as I touched on earlier, it's most likely to be a couple of forms, and similar into that 920 form that I touched on. But the details are still to come there. So we'll see, hopefully, there's further guidance in the coming days.
All right. We've had a couple of more questions, which is great. Thanks for that. The question is there any guidance or best practice from APRA or external auditors on timing of a review of assumptions and estimates during COVID-19? While you usually would review assumptions once a year, what are they expecting now and when? So, at least publicly, APRA has not provided significant or kind of detailed guidance on how many times they would expect assumptions to change. That being said, they do expect entities to, as part of their internal assessment of the capital adequacy, to adjust their, scenarios and assumptions almost on a continuing basis. So as and when data becomes available, entities should be reviewing internally their assessment of the adequacy of their capital base. So similarly, with regards to estimating expected credit losses, whilst there's no requirement as such to do that on say every reporting basis. So the estimates, while they're not going public, they are part of the 720s returns, for example. So that's a monthly return where ADIs are reporting the collective and individual provisions. The impairment returns, so the 220s are I believe quarterly forms. So it'll be between monthly and quarterly, I'd say, in terms of from an internal assessment process, I'd probably say that management will be interested in understanding, their evolutions across their portfolios on a very kind of short time frame window. So probably monthly would be my suggestion, if that is feasible under the from an operational perspective, of course. I'm mindful of the time, and we did have a couple of more questions. And so what I suggest we do is that we will contact the people who have sent additional questions after the session, so we can wrap it up within the current time frame that was allocated.
So thank you all. Thank you, Thomas and Iggy, for your commentary today. We look forward to providing another webinar as more changes come out from APRA, and we'll get in touch with everyone on the call when that comes out next. And thank you. We do direct you to our website if you'd like to follow up in any more detail. Thank you again for today. And stay safe.
Thanks all.